In this video, traders, we're looking at the basic differences between puts and calls and some similarities as well. Stay tuned. Hey traders, one for you options traders out there, or those of you who are new to options. So puts and calls. Let's just go through first defining what a put is and what a call is. I've got other videos where we've distinctly drilled down into those, but just as an overview, let's have a look and then look at some of the similarities and some of the differences and discuss the two. So a call option is generally a bullish idea of the market. It's a bullish thesis. A call option is the right to buy a certain, if we look at a stock, let's use a stock as a great example, the right to buy a stock at a specific price at a specific time in future. So if you had a $50 call option with June expiry, and let's say the company was trading at the moment at $20, if you bought one of those, you've got the right to buy XYZ stock at $50 in June, and there'll be a date with that as well. You might say, why would you want to do that? The point is that will cost you not a lot of money. That might cost you, let's say, 10 cents, okay? Because at the moment it's trading at 20, the thing's got to go to 50. It's unlikely. However, if it does happen, all of a sudden you're going to make a lot of money. And with a call option at expiry, the value of that call option at expiry is the strike price minus the current price. So let's say it's trading at expiry at $55, all of a sudden you've made $5 per call option, a massive return on the 10 cents that you paid there. Right, so that's a call option, and not forgetting that actually the value of this will increase. You don't have to wait till expiry. It could increase dramatically. If that stock suddenly rallied the next day to $30, you can bet the value of that is going to be way higher than 10 cents, probably 50 cents, 60 cents, 70 cents, something like that. That's the premium. You can also buy out of the money calls as well. And we've talked about this in deeper videos, but just as a summary, let's say we're trading at $20, $50 will be out of the money, and in the money call will be something like trading at $10. It's got $10 worth of value and a little bit of premium as well. So it's bullish. It's a way of having a just bullish thesis without owning the stock. It's perhaps a way of hedging if you're short and you want to buy some call options to prevent a kind of a blow off top, whatever it may be. Put options the other way around. Put options are the right to sell something at a future price at a future date. So at a price at a future date, should I say. So if this was a put option, let's just flip it, and it's exactly the same criteria. So it's a $50 put option, it's currently trading at 20. You'd have a lot of intrinsic value in that because you've got the right to sell something at 50 that's currently trading at 20 or $30 worth of intrinsic value plus the spread. But let's say this was, I don't know, let's change it to 70, for example. Let's say it's suddenly trading at 70, you've got a $50 put option out of the money. Maybe you'll be able to get that cheap. Why would you do that? Because your thesis is this thing's going to go lower than 50 before June, and you buy a contract of that. So you've got the right to sell XYZ stock at $50 at that June expiry. Of course, if this stock happens to be above that, it's of no use, there's no value. Anyway, so puts are also a great tool for hedging against a portfolio risk. So if you've got a portfolio, and let's say you think, hey, you know what, there might be a downturn in the next couple of quarters, I'll buy some put options on the broader market. That will protect you against downside, whilst you'll still get some juice from the upside. So you lose the cost of your options. If we carry on rallying, you'll lose the cost of that hedge, which is how much it's cost you to buy the option, but you'll still get the gain from your portfolio. If, however, we go to the downside, you'll lose on your portfolio, but you'll gain on your put options. So it could reduce the amount of damage done by that downside move. So with that real quick explanation, as I say, go and check out some videos I've done for a deeper explanation into those if that's something you want to look into further. Let's have a look at the similarities and differences. So similarities are they both can be used as hedging tools. Like I say, if we've got a portfolio, a put option is the perfect hedge. A call option we could use, again, if we're short, perhaps we're short and we still think it's going lower, but we're worried about perhaps event risks. So we might buy a call option to prevent that spike higher, or we could use a different spread between calls and puts, buying different ratios of the two to generate some kind of hedge for our portfolio. Very useful hedging tools, and that's really, you know, some of the big uses from them. And we see that as well when people are a little bit nervous about the market declining. A lot of institutions will pile in and buy a lot of put options, buy a lot of stuff to hedge with. And you could sell a call option as well to hedge as well, but won't go into that in this video, although I have done, again, a separate video on that if you fancy checking that out. Okay, second one is implied volatility sensitive. So they're sensitive to the implied volatility, which makes up the price, how volatile people expect this stock or underlying asset to be. If they expect it to be hugely volatile, both the calls and the puts will increase in value. If there's no volatility expected or low volatility expected, they will decrease in value. So they're both proportionally sensitive to that. Time erodes value. So as the time is coming closer and closer to expiry, they are getting worth less and less. That's the same with the put and a call. Because you think about this $50 put option, if it's still trading at 170 with a couple of days left to expiry, it's going to be almost worth. So the chance of that going from, sorry, not 170, 70 to 50 in 2 days is very, very slim, unless it's earnings or something, but very, very slim. If it was 2 years, the value is going to be high. So as time goes, you get what's time decay, which is called theta, which decays and reduces the value of both the put and the call option, regardless if you're in the money or out the money, because the premium you're paying is worth less and less with each day that goes by, because the odds of it moving to that, or the odds of it doing something unusual, are less and less. Okay, so what have we got? Used for directional bets. So they're both used for directional bets as well. In other words, if you're bullish, you can buy an outright call option. If you're bearish, you buy an outright put option. Or if you're bearish, you might sell a call option. If you're bullish, you might sell a put option. Different strategies, again, videos for that as well. So there's the similarities, very similar. Those. The differences are these. They react inversely to each other versus the stock price. So as we said here, time goes down, both of the value of the options goes down. With the stock price, if the stock price goes down, what happens, the value of the put rises because the chance of that happening gets higher. So if that goes down to $60, then that put option becomes more valuable because it's closer to the strike. If we had a call option, however, if the price goes down, then the value of that call option goes down. So there's an inverse correlation, vice versa, if the stock price goes up. The dividend dates as well, different reaction as we approach the dividend date. The call option reduces in value and the put option increases in value. Something to note there. And the final thing here, guys, calls with low strikes are worth more than calls with high strikes, and puts with high strikes are worth more than low strikes. If you think about this, if we had a stock that's currently trading at $50 and we had a $10 call option and a $20 call option, what's going to be the most valuable? The $10 call option is going to be the most valuable because the right to buy something at 10 that's currently trading at 50 has way more intrinsic value in it than the $20 one. And of course, that depends. Also, it's also going to be the same regardless whether that's 500 or whether that is 5, because you're going to have more value in the lower call, because the right to buy something that's lower is more valuable, right? The right to buy something at a less price than the other one is more valuable. If you put on the flip side of the put, high strike is worth more than the low strike. The right to sell something at 20 is more valuable than the right to sell something at 10, regardless of where the strike price is, even if it's 50 or if it's at 5. So that is the difference between puts and calls in that aspect. So those are the similarities. Those are the differences. Puts v calls. If you want to check out some others videos on the channels I've done about options, please feel free. Subscribe for more videos like this from me and other traders on the channel, and take care. Good trading, whatever you're doing. Bye bye.